Good afternoon, everybody. Welcome back. So, as I mentioned, we have an exciting panel set up post lunch. So, that's on the views of equity markets and alternative investing, domestic and overseas. We have Mr. Arunagiri, founder director, Trustline Holdings, who has more than 17 years of enriching experience in capital markets in various capacities. He has also come to believe that the key to success is value investing lies not so much in financial skills but in emotional and temperamental skills. He's set up a trust line in the year 2004 after his illustrious career spanning over 15 years in Wipro Technologies. A very warm welcome to all of you.
Arun, I mean, you have been part of equities for a long period of time now. Uh, if I were to ask you the same question about valuation 6 months back and where it is today, what is your view now? Let me ask you on 4th of March today, where are you looking at valuations now? And maybe you want to break up into large, mid, and small cap, etc., and all that. You're on mute. Sorry, in case if you're talking. Yeah.
Hi, Sanjay. Thanks a lot for this invitation. Thanks for this opportunity. I'm really privileged to be part of this. So when you look at valuation, there is a general tendency to look at valuation with a common look at valuation on an aggregate basis, right? At Nifty level or Sensex level and all that. That could be really misleading. There could be extreme divergence within that basket. So even in this current market, that after 2 years of rally, what we see is one segment of market like IT, if you take, extremely expensive on historical terms, even after the correction in the current phase. Whereas if you look at pharma, financials, and so many other sectors which are going really dead cheap. So I think painting the entire basket with the same brush may not be a very wise, sensible approach. I think the right approach would be to look at, very selective basis and look at the pockets of undervaluation. Believe me, there are many, many pockets of undervaluation in this market, even after 2 years of rally. For any savvy investors, there are many, many opportunities. That is the first part of the question, Sanjay. Coming to your second part on the small mid caps, let me give some, historical perspective. If you look at any bull market cycle, right, initially the first leg of the rally always is led by large caps, Nifty and Sensex. This is when you have a large amount of liquidity sloshing around the system and the growth gets a rewarded growth strategy. But as the bull market matures into a mid cycle, what happens is the action shifts to small and mid caps. And you go back and see 2004 to 7 cycle or 2014 to 17 cycle, you would see a same pattern playing out. Actually, from 2016, I think the entire alpha was created only in the broader space. We see something similar happening, but for this geopolitical situation, I think you would have seen a lot more action in small and mid cap. Yeah. So once the dust settles on geopolitics, I think we see a lot more action in the broader space. So the stock specific portfolio building is the time. The time is for stock specific portfolio building to create that kind of an alpha return. That's what I would say. So in the current phase, once the dust settles on geopolitics, I think the Nifty and Sensex probably will adjust a little bit because of the correction. So initial rally would be there. But I think when you look beyond 6 months, I think more and more action would happen in the broader space with Nifty and Sensex consolidating. Something similar to what we saw between 2016 to early 2018. So this is the time to be there in multi-cap and small and mid-caps. This could be a little contrarian view, but if you look at the past cycles, I think the pattern is very clear.
No, sure. So as per you, this is a clear thumbs up for sure. I can see that for sure, no doubt about it. I mean, Arun, if I were to ask you, I mean, we have seen this market for last few years now, maybe 2-3 cycles for last in say maybe 17-18 years now. Market, have you actually analyzed the balance sheets? You look at financials of banks, NBFCs, etc., and especially with interest rate about to be hiked. I don't know after Powell's statement yesterday, who will sneeze and who will catch cold? I don't know right now, but which sectors do you feel good for the investors to bet on? So or have you changed your mind after Powell's statement yesterday? If I were to ask you that?
No, we've become more convincing now. Okay, it's more compelling now.
Sure.
Sanjay, so let me take it this way. I think this question, I will spend a little more time, a little longer time. So to look at the macro, the biggest tailwind for the economy right now is not anything to do with the pent-up demand from pandemic. or any temporary government stimulus in terms of capex push and all. Of course, they are all helping in at the margin. But in our view, I think there are two factors which are the real great tailwinds for the economy, and it is not well appreciated by the consensus investment community. One is the cumulative base effect, or you could say the cumulative pent-up demand coming off a very, very low growth for the last 6-7 years for India. I think the last time we saw any growth above 7% was in 2014. After that, the economy has been just languishing. Your capital investment is below the trend line. Your manufacturing share is below the trend line. So it's been just languishing. The second factor is the cumulative impact of the painful reforms this administration has done for the last 6 years, be it GST, be it IBC, be it MPC, and to some extent even DeMon. So these are two factors which are really underestimated. And this is what is going to drive the economy to, in the medium to longer term, to the trend line growth of 7 to 8%. So the good news is the reforms are stabilizing, GST is stabilizing, IBC has given some fantastic outcome. And, the DeMon effect plus the pandemic effect is really putting, organized market at strength. So all these are going to drive the economy into a real solid trendline growth of 7 to 8%. And that kind of a backdrop, there are many, many sectors and themes the investors can look at. So given this backdrop, I think more than sectors, what we would look at is the kind of themes which are likely to play out for long time to come for India. One is formalization. This has been discussed, and a lot of it, some of it we saw play out in the last 2 years. This is thanks to the reforms like GST, as well as some accidental impact from pandemic. The weaker players are getting weaker and stronger players are getting stronger. The market share is shifting from unorganized to organized. And this is not happening only in the large cap space. It is happening across the spectrum, in mid caps, in small caps, in micro caps, and large caps. So any savvy investors, I think consolidation is a big theme one can look at across the spectrum. No sectors, spared. You can look at any sectors in which you can then, most of the gains, market share gains are being, it's getting accrued to all the listed players because listed players are organized guys.
Yeah.
Second theme one can look at is a financialization theme. It's again, it is, though everyone talks about it in the market, I think people are ready to see the benefits. So the saving shifting from physical assets to financial assets, this is going to play for a very long time to come for India, And you could look at, anything, any exchanges, depositories, new age broking firms, or, financials, private sector banks, rating agencies, and, something like that. Even asset management companies. Asset management companies are going so cheap. There's, they have a CAGR growth of 16 to 17 to 18% per annum, and they're available at a substantial discount to intrinsic worth through free cash flow model. So there, you have a lot of opportunities in financialization. Besides this, I think one can look at China plus one, which if one can look at manufacturing scale up because of the PLI focus from the government, or capex breakout cycle. So these are well discussed. I don't want to spend too much time. So basically, the kind of themes one can look at in summary is formalization, financialization, China plus one, and then manufacturing, big manufacturing scale up, and then finally the capex cycle breakout. So there are a lot of opportunities across these particular themes one can find. Many sectors.
No,
so it's a great time to be an investor, I would say.
After talking to you and listening to you, I can only tell you I should be all in right now. That's what I'm feeling.
Of course, there is a caveat. Sure. Of course, there is a caveat that the current conflict, geopolitical tension, we assume that to be a limited one. If it escalates into a wider conflict, of course, your thesis could change.
No, that's fine. I mean, that's understandable. But as long as you can behave like a genius and sit tight, it's fine. Doesn't matter.
Yeah.
So that's the only thing. When we're talking about alternate, I think Arun, maybe flip back to you again, because you've been an expert of AIF space. Do you see that as a better space, or looking into direct markets directly, or through mutual funds, or through any other option? Is this a good space
Yeah,
to be?
yeah, yes, Sanjay. Let me give some interesting facts for AF. AF is one of the fastest growing investment platform for ultra HNIs and HNIs compared to the conventional PMS and mutual funds. So look at the industry growth numbers; they are really stunning. Your PMS and mutual funds. In fact, it's been, as I said earlier, it's been growing at 17-18% per annum. The last 5 years, yeah, assets have grown at a stunning rates of about 70% per annum CAGR.
Wow.
So, and currently we are talking about the industry numbers of 600,000 crore rupees, which is 6 trillion rupees. That's the industry size, and it is really growing so strong. There are certain factors which are really driving this growth, especially when it comes to Cat 2 and Cat 3. Cat 3 is where we specialize. The factor is one of the biggest factor which is pushing Cat 2, which is seeing biggest growth. If you look at the assets across AF, I think Cat 2 is the biggest assets, right? And it's also growing at a much faster clip. The reason that the factor which is driving the assets in AF Cat 2 is the debt mutual funds, because they are giving low returns, that is pushing this ultra HNIs and HNI investors to look for, sophisticated strategies which can deliver higher returns, right? That's how AF Cat 2, AF Cat 2 has the flexibility to invest in real estate, structured debt, venture debt, etc., and all that. So that's one of the reasons why it's growing. When it comes to Cat 3, it has a huge flexibility vis-a-vis your PMS in terms of having, structure a very close-ended, concentrated strategy in either micro cap or mid cap or small cap. So that gives you the flexibility of hard lock-in. Today, we all know that PMS doesn't have a lock-in. SEBI has removed that lock-in provision. So
Yes.
if that way can be really, you can build a very concentrated portfolio and with a longer lock-in so that you can deliver much higher alpha, right? So in that sense, we run an AF fund in micro cap, a very deep value strategy that has done very well. It's almost like running an early stage investing in
Listed
public
space.
markets in
Yeah.
listed space. So
Yeah.
it's a very interesting space. It offers different kind of options for investors. It's here to stay, and you are going to see more and more investors opting out for AF compared to the conventional ones.
Maybe if you want to give a short answer, maybe to give a view, because there is a long-term bet or a long-term debate on the word called value and growth investing. Okay. What is your take? You are still a value side now or a growth side?
Of course, we are on deep value side. Okay, this is a very
Yeah.
interesting question. So I'll try to keep it very short given the time
Please.
limitation. So let's first look at how to define value and growth, because there are a lot of myths around it, right? Yeah, in our view, value is not about picking some cigarette on the road and with basically picking stocks, cheap stocks in terms of price to book with no growth potential. That's not value in our view. In our view, I think value is all about picking growth at a discount, and growth strategy is all about buying growth at any price, right? If you define value like this, there's a lot of value you can create. Our own performance over the last 17 years is a proof for that. It's a testimony.
Mhm.
Like, so in terms of value and growth, let me also tell you how they perform in cycles, right? So initial part of the bull market, and when the economic recovery is a little fragile and the liquidity is sloshing around the system, growth strategy rewards like anything. But once the bull market matures into mid-cycle, when liquidity starts getting tightened, that the market starts slowly shifting to value, like what we saw in the earlier cycles. And you're already seeing that phenomena playing out in this correction. Expensive stocks are getting beaten much worse than the value stocks. Value stocks are much more resilient in this correction than expensive stocks. I don't need to give examples because all of us know about it.
Yeah.
So that way, I think value can create a lot of value if you define value as a strategy of picking stocks, growth, basically a strategy of growth strategy, but buying at a discount, right? And our own performance, if you look at, we run a deep value strategy for last 17 years. It is done north of 20% over 17 years. So value strategy doesn't just create value. It creates a lot of alpha for investors if you stay around that strategy.
Yeah. Okay. Well, good to hear that, because we have seen in value funds in the mutual fund space have also done very well in last about 2-3 years time, and people have understood that. Let me thank panelists for all your prudent views, and we been very specific on the various points. I'm sure audience must have been enlightened with your views. So thank you so much for sparing time on this Friday afternoon. Have a great weekend, and thank you so
Thank
much.
you. Thank you.
Yep.
Thank you.
Thank
Thank
you.
you,
Thank you,
everyone.
sir, for having us.